and welcome. Today we are diving deep into the Indian markets pulse with Rajat Chandak, Senior Fund Manager at ICICI Prudential Mutual Fund. From navigating high valuation to bold bets on small caps, Rajat will share his insights on where value lies and how dynamic strategies adapt in today's evolving market. Let's get started. Welcome, Rajat.
Thank you. Thank you for having me.
Let's begin this discussion with our first question. What is your view on the current Indian market landscape with valuation running high across segments? Where are you spotting value today?
No, it's a fair question in the sense that, markets have, done reasonably well. Recently, they have climbed up to highs. It's difficult to find pockets of value really at this point of time. But where at least I am seeing relative value within the space is in the consumption basket, actually. You look at some of the large retailers, for example, you know, the growth has been slightly challenging for some of them, and that has taken a knock on their valuations to some extent. Even though one can argue that absolute valuations may still be not very cheap, but relatively, when other spaces have done well in this market, relatively they have become more attractive. Also, in terms of medium term outlook, thanks to the tax cut, which was announced in the recent budget, and also the outlook on monsoons being, good, should help revive demand. Demand has been reasonably slow in the consumption basket in the economy for a few quarters now, actually. And as and when that cycle of demand revives over next couple of quarters, I think consumption as a basket uh, should do okay. So that is one pocket which I think relatively looks attractive compared to where they are in their business cycle. Second is obviously banks. Some of the large banks they still look reasonably valued within the markets. So that's another space where we are seeing value at this point of time. Still, some of the banks have done well, but some are still there's still some scope for catching up in terms of valuations because even now valuations are reasonable in some of those names. Power is another space, in the PSU basket, not in the private basket, but power PSU. Some of those names are also reasonably valued at this point of time. So, really, then in a lot of other sectors, it's more bottom up. One or two odd names in a particular sector, which is still relatively valued attractively. But broadly, I think these two or three spaces is where still you are okay in terms of relative valuation, given where the markets are.
Rajat, but given the market scenario, what we have seen after the February March, after the fall of the February March and the recent rally, what are the key risks which you see in the market, whether it's a macro or a it's a corporate or sectoral or a sentiment and driven? What kind of risk do you foresee in the markets?
I think the big risks which can create volatility in the near term is more global in nature, in our view. What is happening in the US, the back and forth on the tariff trade wars and stuff like that. So the other risk which we also foresee in the sense is there's reasonable chance of the US economy itself slowing down a little, and mathematically also it will just pull down the global growth. That is one outside risk which we are seeing, in terms of global slowdown, that may have some impact on markets. But the good part is at least our economy is more domestic oriented in that context. And even so far, result season is almost towards the fag end. Results have been reasonably okay for the quarter for our markets. So at least you are getting some support there in terms of the results which the companies are have announced. So risk is more global in nature. Um, in the Indian context, though, still, as I mentioned, that there is a hope in terms of demand revival, thanks to the tax cut or better monsoon. The forecast, which are there, and probably some capex and government spending picking up. If that for some reason doesn't play out, is the other more local risk which can come up over next couple of quarters. So there's some hope of demand recovering going ahead is what is built in, or it's at least it's expected. Maybe that demand revival should be on the cards next 1 or 2 quarters.
You also place high importance on management quality and stakeholder fairness. How do you evaluate these softer aspects, especially in mid and small cap companies where disclosures are often patchy?
This is where bottom up ground research comes into play. So I believe in we just keep talking to some of the stakeholders in these companies and businesses, be it their mid-level management, ex-employees, dealers, distributors, suppliers. So entire, you can say ecosystem, and not just going by what the top management is saying, the CXOs of these companies. So you can really do some groundwork, try to get feedback in terms of, the processes, the systems which the company is following, how transparent and fair they are in their dealings with some of these stakeholders. So really it's groundwork which the entire team does at ICICI Pro AMC to help get that feedback. Because in the long run, what I have seen is companies which have been fair in dealing with all the stakeholders, including customers actually, if they are offering value, do well in the long run. They really do well in the long run. So I think it's in my investment thought process, that's one of the key pillars which I do look into. Obviously it's easier to do in some of the sectors, this kind of groundwork, more B2C oriented companies where you can talk to a lot of people on the ground compared to a B2B, oriented company where you have limited access or limited stakeholders to speak to in that context. But we do try to get that feedback on how the company is running its business, what's the thought process is there of, let's say, a promoter or the management, etc. So that really helps us form a view. Obviously, it's more qualitative in nature, because there are no numbers to it, right? It's just a feedback which you try to collate over time, and have an impression or view on a particular company basis that. But it's a continuous process. It's not that once you have formed a view, basis this feedback, you just remain with that view for a long period of time. It's a continuous process. You keep checking whether things are changing for the better or for the worse. It can move in both directions. So it's a continuous process. Keep checking, taking feedback from the ecosystem.
Rajat, now coming to some of the fund specific thing, the Balance Advantage Fund, which you co-manage with the other fund managers, had a lower equity allocation during 23-24, which affected the performance of the fund. But now it's back in the top ranking in 2025. So what strategic recalibrations have worked in its favor?
I think actually, if you look at it, basis published portfolio itself, I think 2 or 3 things which we did change in this year was, we were reasonably underweight IT as a sector, but which we added recently, once the valuations corrected, and thanks to, again, global uncertainty, what was happening in the US, etc., which gave us an opportunity to, add some of those names at much more attractive valuations versus where they were earlier. So that was, one thing which we changed. Then, we also added oil and gas space, the large conglomerate there, again, valuations are becoming relatively very, very attractive for this name, and which we added in the fund. Apart from that, if you really ask me, it was, just the existing holdings themselves which helped the performance this CY. So, auto space, OEMs which we have held for a long period of time, some of those names performed well so far this calendar year. Within the financial services space, life insurance was, one space where we were overweight on. Some of the capital market plays which we had in the fund, which we added when markets gave us opportunity. So, just some of the existing holdings themselves, the starting positions itself, also helped quite a lot. We were meaningfully underweight on FMCG as a space, and a couple of names on a bottom-up basis which we had. did better than that sector itself. So these three or four things really helped. And one of the other big ones have been large banks. Banks have done well this year, and that has also helped the performance. So two or three things which we changed per se, but other things were as it is in terms of the existing positions.
As we speak about this for this fund, it dynamically shifts between the equity and debt. So what kind of investor profile it is best suited for? Would it be appropriate for someone who is looking for a 50-50 exposure towards debt and equity?
Yes, if you look at it, mathematically what you are asking is correct in the sense that, it's dynamically managed, the equity allocation. The range which we follow in this fund, balance advantage fund, is between 30% to 80%. So if you really look at over time, if, the fund on an average would be in the midpoint or around that, it'll come around 53, 54, 55% kind of a net equity exposure, over a long period of time. Even though there can be phases when markets go up one way, it will be much below that. Could be 35, 40% in that sense. But yeah, over long term, it should be around 50% of net equity exposure in this fund. So that's a fair assumption in that context. I think that risk-adjusted returns is what I harp on for this product of ours, Balance Advantage Fund. If you look at long periods of time, despite having on an average, let's say around 50% of net equity, the fund, depending on what time frame you look at, would have delivered 80 to 100% of nifty returns. So, just having half of the risk of equity in terms of allocation at around 50%, you are getting almost 80 to 100% of nifty returns in that context. Now, I would also want to add one more thing. Then people would ask, then why I would not just buy a Nifty ETF or just Nifty itself. If you are delivering Nifty returns also, hypothetically. The thing is that it gives a lot of peace of mind during drawdowns, especially. So there have been times when markets fall whatever 10, 15, 20%, and fund, thanks to its cautious allocation at that point of time, would fall only 30 to 40% of what market has fallen. So if market has fallen 10%, probably the fund has fallen 3 to 4%. So, during those times, really, it gives peace of mind. In my view, it should give peace of mind to our investors in that context. So, the risk-adjusted returns is what I would like to, highlight for this fund of ours.
If we look at the performance of this fund in 2024, does a prolonged upward market make the dynamic allocation model look cautious by default? And have you considered adjusting the model to respond to the faster in such cycles?
Yeah. So, I would again want to say one thing which is permanent in our markets or any market actually would be volatility. So even if when you ask me that in an upward trending market, the model looks cautious or, maybe you were underweight equity and it would have hurt performance in certain pockets of time. But even, if markets are in general trending upwards, right, they're never in straight line. They'll go up and down, up and down, up and down. So, that volatility does give us an opportunity to add, equity exposure at attractive valuations. I think that is one thing which I would want to highlight. That volatility is always there. It gives us an opportunity. Even in an upward trending market, you have instances that markets do correct 5, 8, 10%, and you can add equity at that point of time. Coming to the model itself, yes, at least at ICICI Pru, our models are more valuations based. And if markets are going up, more than what earnings growth are going up, or let's say more than what the book value accretion is happening to the market, to the broader market. That means that the markets are becoming more and more expensive, right? So and valuations, if they are becoming expensive, it's only prudent to cut weights on the equity side. So it would look like that for us, at least. If valuations are expensive, we will happily stay underweight equity versus what benchmark is, or whatever our model is suggesting in that context. The third point now is in terms of whether we keep looking at ways to improve the model. The answer is a big yes. At all points of time, we keep evaluating, keep discussing internally how can we make the model better. The many times, at least 2, 3, 4 times a year, somebody comes up with an idea that we could add this factor to the model, or we could remove this factor from the model. Probably the output could be much better in terms of let's say adding equity or reducing equity at a better time versus what the existing model is telling us to. We keep doing that stuff. Our investors can rest assured that, we are not, just sleeping over our, past performance or laurels that, the fund has done well or model has worked well. We always continuously strive to improve the model itself. And we have made changes, but it's after a very, very deep deliberation, and a few team members of us sit together, me, Naren, Manish Manthia, Anish, a couple of other colleagues of mine, co-fund managers, 5, 6 of us, discuss, decide whether logically it makes sense first. Then we back test it with that data, had this data or this factor been there in the model for last 15, 20 years, whether the performance of the output would have been better than what we were getting already. We deliberate that, and I'll tell you that, four out of 5 ideas, or maybe 8, 9 out of those 10 ideas actually go out of the window. Like, they would add only very, very marginal improvement, if at all. So we keep looking at ways to improve the model. We would have probably changed or added some factors maybe 2 or 3 times in the last 3 or 4 years. But that doesn't mean that we are not looking at improving the model. That's always the endeavor.
Can you explain what are the factors which you have added in the last 2 or 3 years, or say, if possible?
No, see, one is, when taxations were changed, in asset classes, so one asset class was, more attractive in that context, given the tax differential in the asset classes itself. That is one. We have also added like earnings yield gap, in a way, because our model was more dependent on price to book valuations. There was always this internal debate that in a phase when earnings growth will be strong, probably this model may turn cautious too early when markets go up if earnings growth is strong. So that's another factor which we added in a way in last couple of years. So and there would be one or two or more, but these two would be the key ones.
So many investors fear missing out during bull phases if they are in dynamic asset allocation funds. How do you address these concerns in the context of BAF strategy?
No, as I said, obviously our investors for this fund have to focus on risk adjusted returns. So, obviously, by definition, being a hybrid fund, even within dynamic asset allocation as a category, where as we discussed that on an average over long term, you will be exposed only to, let's say, around 50-55% of net equity levels. So that the investors have to keep in mind that risk adjusters go hand in hand. So if we are taking lesser risk in these kind of products, balance advantage fund, obviously returns in some phases would undershoot the market returns. But as I said, if you look at a longer term horizon, let's say 7, 10, 12 years, the product has been able to capture anywhere between 75-80% to 100% of market returns. So yes, returns would be slightly, at par or slightly below market levels, thanks to just the product construct, right? It's a conservative hybrid product. But investors really have to see over time how the fund has delivered or the category has delivered. So yeah, it's suited for a particular risk profile, which some of them would be okay with.
Arjun, coming to the Flexi Cap Fund, it has done consistently outperform peers since its launch. Could you walk us through the core strategies or the call that has driven the outperformance?
I think Flexi Cap is a very interesting category because one, obviously we have got no restrictions in terms of market capitalizations. We can straddle through small caps, mid caps, large caps, in whatever ratio we want to whatever proportion of the fund we want. Here, my focus. So balance advantage fund, is a different product where we do a lot of readjustment to equity allocation. So there is a lot of trading involved in that, right? Because every day we get an output from the model that where should be net equity levels, and we make those adjustments. So it's a very it's more a trading fund in that context. We trade a lot in that fund to adjust the net equity levels. FlexiCap is much more suited to my style in the sense where I believe in more buying and hold kind of a strategy. So if you look at a lot of names which are there in published portfolios, I've been holding for a reasonably long time. Obviously the fund is just over 3.5 years old. But even within that, you would see some names have been there for a pretty long time. Could do a lot more bottom-up work, because in buy and hold, you really are taking a more longer-term call on a particular company or a promoter or a management or a category. So without worrying about equity allocation being adjusted, etc. So that is one thing. Second is, I don't believe in taking cash calls. That is another thing. And maybe the phase of the market which we have seen last 3 or 4 years, markets have also done well in general. So post COVID, right? So that also would have helped. I remain mostly almost fully invested in this fund for most period of time. So those are the two things. Generally, I've been more focused on consumption-oriented spaces, because as I said earlier, that in my view, at least, a lot more bottom-up work can be done in these B2C names. You can do a lot of, channel checks, about the company. There was a question earlier about, how do I judge in terms of, management quality or, whether they are fair to their stakeholders, etc. And I said that time also that it's easier to do it in B2C companies, and which gives a lot more comfort to me, in that context, to take a big bet on any company. And hence, obviously, it's been in general more consumption heavy portfolio in last couple of years, maybe since beginning. That has also hurt the performance recently, because as I said, consumption has been going through some kind of slowdown in last 3 to 4 quarters at least. But hopefully that would revive. I think as economic growth picks up, and the other factors which I mentioned, it should revive at some point of time.
But Rajat, if I look at the portfolio, you have slightly overweight on the small caps. So has that strategy also helped in terms of outperformance of the fund?
It may have, depending on the phase of the market, but I think over last 2 to 3 years, it would have helped. It would have helped. That's another question, interesting question, that, I've been having more small caps versus, maybe some of the peers or, even internally here. But I think, there's certain pockets or categories of businesses or industries which are small and which you can actually play only through some of these small cap names. It's more about a particular category which is more exciting, which looks more exciting in terms of growth or opportunity over medium to long term. And hence, to play that, there are only those handful of companies in the small cap space itself. It's more driven by that, interesting categories where you can only play through small caps, and I'm okay doing that. And most of these calls are actually more bottom up. It's not that top down. I take a big view on, let me be meaningfully underweight small cap or let me be meaningfully overweight a small cap. It's not that. I do keep in mind though what the benchmark has, which is around 27-28%, I think 25 to 27% in that range in terms of allocation. So that is what I keep at the back of my mind, that don't be too overweight or too underweight. Otherwise, most of the calls are more on a bottom-up basis.
So, like you just mentioned, the fund's small cap exposure is also relatively high. With the recent froth in that space, how do you define the risk reward now? Are you planning on any calibrations in that zone?
See, there are 2 or 3 things when, a reasonably sized fund is investing in small cap, right? One is that you have to have slightly longer time horizon in small caps. If you are really betting on a small cap, you have to have a longer time horizon of investment. Really let the thesis play out over time. Second is, the liquidity itself in small caps, it is reasonably low, right? It's pretty low in the sense that you can't really easily trade in and out of these small cap names, because, by definition, they are small caps, and the value traded on a daily basis for a lot of these names is very, very small. So you can't really change the portfolio overnight within the small cap space. So I think these 2 things is what I would want to communicate. One, it's more bottom up, medium to long term perspective in terms of, the investment horizon. And, all companies or businesses will go through their own ups and downs, driven either by, macro, let's say slowdown in growth, etc. But you really have taken a call from 3 to 5 year perspective when, things would really overall from point to point perspective should look way better than what they are today. And over that time, probably you would create some alpha in some of these investments in the small caps. So yeah, these two things I would want to highlight. One is investment horizon is generally longer. And second is that it's not so easy to change the portfolio, at some size meaningfully. You can make 2-3 percentage points here and there, allocation changes to market capitalization, but not that easy.
Rajat, you mentioned about the consumer, you're bullish about the consumption theme, but just wanted to understand on the financials, you are quite, quite underweight in the financials compared to the Flexi Cap category. So what's the reason behind that?
Well, no specific reason. If you look at it, FlexiCap also had a decent position earlier on in the financial space as a category, but some of the large banks have done really well. Life insurance as a pack, which FlexiCap, our FlexiCap has been holding for some time as per published portfolios. That has done really well. So just trimmed some of those positions, and hence it looks like we are relatively underweight. But yeah, I think it's okay. The pack has done really well, and relative valuations, even though are okay, but you just would want to book some profits in some of these names.
So, how do you handle the cyclicality of the transport and logistics sector within the construct of a long only equity fund?
If you look at that as a theme or a basket, it's a reasonably large space which we play in. If I were to just highlight 2 or 3 points there, in that theme, there's automotive as a large sector which we can play in. Now, even within auto, you have OEMs and suppliers. OEMs itself have, like two-wheelers or four-wheelers or commercial vehicles, etc. And, sometimes, many times actually, these subsegments themselves go through their own different cycles. So, as we speak, probably two-wheelers are doing slightly better than, four-wheelers, for example. Okay, so even within that space, each of that category sometimes can go through different cycles. And then you have automotive supplier ecosystem. Okay, within that, there are a lot of auto angs which are focusing on export markets, which are dependent more on what's happening in US or Europe, for example, or other OEMs. Within India, also, companies which are focused on, thanks to the content growth which is happening in the space, more and more features getting added, more and more regulations coming in, be it emission norms, be it safety norms, etc. So really, the content growth is happening way more than the volume growth in the space itself. Some companies benefit out of that. And then if you look at logistics as a basket itself, you have aviation, you have even the food delivery guys, which are also part of the bench market sector, come into the logistics space, etc. You have a reasonably diversified basket to play within. So I think so far we have not faced a challenge in that context that everything is very expensive or where to invest in, or vice versa. So that's not a challenge. It's a reasonably wide basket within which we are playing.
Well, that brings us to the last question for this session. Are you seeing value in large caps after the recent broad-based rally in mid and small caps? Are there any signs of reversal coming through?
Yeah, I focus more on bottom-up basis. Okay, as I said, like even though you are right when you're saying that with the recent broad-based rally, probably mathematically the small caps and mid caps are looking more expensive as a basket. But you will always find pockets where valuations even within small caps and mid caps are reasonably attractive. I tell people, if we covered almost 500 companies in ICICI Prudential. In that, I can at least find 5 or 10 names in the small cap and mid cap basket, which is going through their own challenges. It could be macro driven. The sector is going through a downturn, and hence, and bad news and good stock price go together hand in hand, valuations. So, some or the other pocket is going through some kind of a struggle. And when there is negativity in a particular space, it's only then that you will be able to buy at more attractive valuations, relatively more attractive valuations. So you can always find some names even within mid and small caps to stay invested in. So even though you are right that on a top-down basis, at a basket level, at an index level, people can say that small caps and mid caps are more expensive, which I can't disagree with, because that's a fact. But you can always find some pockets of interesting industries, interesting segments, companies, which are not that expensive.
Well, thank you so much, Rajat, for sharing such valuable insights with us and our audience. Thank you so much.
Thank you so much for having me. Thank you.